for people that are still coming up to speed here, I have one of my students the other day, and I want to talk about stablecoins too, but they said, why is this such a big deal? Because I get them to go on like Compound and borrow and lend an asset in small size just so they see what it is, because most people have no concept of this, right, Robert? Because we know our stockbrokers, was the best kept secret for a long time. They would hold our shares and lend them out overnight when we just thought that you couldn't do that. So how do you usually educate people on the fact of financing assets? Because we don't normally, Airbnb maybe is an example, I guess. We don't normally finance our cars. Or how do you usually explain that? And why is it such an important building block to the whole system?
Yeah, it's a great question. So, you mentioned a point, which is, all the stocks in the world, that most people are sitting on, overnight, their broker is lending them out to a short seller or in some way to earn just a little bit of extra income for themselves. And most of that value doesn't accrue to you. The idea behind Compound is that, originally we thought, okay, all idle assets out there, and starting with crypto assets that were available in the Ethereum blockchain, if somebody wants to borrow them, it should be freely available. And the people with the asset should be receiving the yield from that behavior. And so, one way to think about it is, people will borrow the assets that you have. If they're borrowing stable coins, they're excited to borrow these stable coins to buy other assets, to essentially, convert the stable coin into more Bitcoin, into more Ether. And then over time, hopefully pay it back. Bitcoin or Ether have gone up, they sell it, they repay the stable coins they've borrowed. Or if somebody's looking to borrow Ether, either to run smart contracts or to sell Ether for something else, or to purchase an NFT with Ether, because that's the only thing that can purchase the NFT, they might borrow Ether. And all of this leads to this process of people paying for the opportunity to borrow assets, and paying the users that provide those assets directly. And the system works in a single player mode basis, where you can just go to the protocol and take the prevailing yield, or you can borrow at the prevailing interest rate. You don't have to call anybody. It's not like, if you wanted to get an interest rate on a treasury, having to work the phones or work the desk or work chat rooms. It's a system that's designed to be, one in which you can just directly interact with the protocol 24/7. It could be 3 a.m. and you could be wearing your pajamas, and the system just works. And so the easiest way to think about it is, if you have crypto, there's a yield available to you on that crypto. And if you want to borrow any of the different crypto assets for any reason, you can do so using other assets as collateral. So the most popular use cases are people taking a basket of volatile crypto assets, whether it's Ether or Bitcoin or Uniswap tokens or whatever, and borrowing stable coins against it, or providing stable coins and other crypto to the protocol to earn the prevailing rate. And the most popular trade has always been borrow stable coins to buy more assets with, or go put to productive use in the real economy, or do anything you want with, against crypto, and other people providing stable coins to earn an attractive yield relative to traditional financial markets. Right now in Compound, stable coins all in earn about 3 to 5%, which most folks are interested in one way or another.